Something fundamental just shifted in the silver market. After years of consolidation, after countless false breakouts, after being dismissed as the forgotten metal, silver has broken through a critical technical and psychological barrier. And right now, at this very moment, millions of investors are about to make the same mistakes they always make when an asset finally breaks free from a prolonged period of compression. I'm not here to tell you that silver is going to the moon. I'm not here to promise you generational wealth by next Tuesday. What I am here to do is far more valuable, to help you understand what's actually happening, why it matters, and most importantly, how to navigate this moment without destroying your financial future in the process. Because here's the truth that nobody wants to hear. More wealth is lost during breakouts than during crashes. More portfolios are decimated by poor decisions made in moments of excitement than by missing opportunities entirely. The silver market has entered a new phase. The question isn't whether something significant is happening. It clearly is. The question is whether you'll be among the disciplined few who benefit from this move, or among the emotional majority who will look back on this moment with regret. Now, let's talk about what's really going on. To understand the present, we need to briefly examine the past. Silver spent the better part of a decade trapped in a frustrating trading range. From 2013 to 2020, anyone who bought silver experienced either modest gains or significant disappointment. The metal that had rocketed to nearly $50 per ounce in 2011 fell back to earth hard, consolidating between roughly $14 and $20 for years. This wasn't an accident. This was a market resetting itself after a speculative blow-off top. Markets don't move in straight lines, and they don't sustain parabolic moves without consequences. During those years of consolidation, something important happened. Weak hands left the market. Speculators moved on to cryptocurrency, to cannabis stocks, to whatever the next hot trade promised to be. Silver became boring, forgotten, the punchline of jokes about doomsday preppers and perpetual gold bugs. But beneath the surface, fundamentals were quietly shifting. Industrial demand continued growing. Solar panel manufacturing, which requires significant silver content, expanded dramatically. Electric vehicles, each containing far more silver than traditional cars, began their ascent from niche products to mainstream inevitability. The technological transformation of our economy requires silver in ways it didn't 20 years ago. Meanwhile, supply faced increasing challenges. Primary silver mines aren't particularly common. Most silver comes as a byproduct of other mining operations. When copper or lead mines scale back production, silver supply contracts, whether the silver price justifies it or not. Then 2020 arrived, bringing unprecedented monetary expansion. Central banks around the world opened the floodgates, expanding balance sheets at a pace that would have seemed insane just months earlier. The implications for hard assets were obvious to anyone paying attention. Silver woke up. It rallied from under $15 to nearly $30 in a matter of months. Then it corrected, as all assets do after rapid advances. It spent the next few years building a base, testing support, frustrating both bulls and bears with its refusal to commit to a clear direction. Until now, silver has broken through resistance levels that have held for years. These aren't arbitrary lines on a chart. They represent real psychological and technical barriers where supply and demand previously found equilibrium. When an asset breaks through such levels with conviction, it signals that the balance has shifted. More buyers are willing to purchase at these prices than sellers are willing to sell. This might sound obvious, but understanding this dynamic is crucial. Technical breakouts matter not because lines on charts have mystical power, but because they reveal changing market psychology. They show us that the collective assessment of value is shifting. But here's where most people go wrong. They see a breakout and assume it's a straight line higher from here. They look at a chart breaking through resistance and imagine it's a rocket ship that just achieved escape velocity. That's not how markets work. Breakouts are often followed by pullbacks. When the market tests new support where old resistance used to be. Early buyers take profits. Skeptics short the rally. Volatility increases, not decreases, during the early stages of a new trend. This is where fortunes are made and lost, not in the breakout itself, but in how investors respond to what comes next. Let's be clear about something. Technical breakouts don't occur in a vacuum. Silver isn't breaking out because traders decided to draw new lines on their charts. It's breaking out because fundamental forces are aligning in ways they haven't in years. First, consider the monetary environment. We live in an era of unprecedented debt. Government debt, corporate debt, consumer debt. All at levels that would have been considered impossible to sustain in any previous generation. The mathematics of debt ensure one of two outcomes, default or devaluation. Default seems politically impossible in most developed nations. That leaves devaluation. Devaluation doesn't require hyperinflation. It simply requires that the currency loses purchasing power over time at a rate faster than nominal interest rates compensate for. We've been living in this environment for years now, with brief interruptions. Hard assets, tangible things that can't be printed or created by fiat, serve as insurance against this dynamic. Silver is among the most accessible and liquid of such assets. Second, consider the industrial demand picture. The global economy is undergoing an electrification revolution. Solar panels, electric vehicles, advanced electronics, 5G infrastructure, these aren't speculative technologies anymore. They're being deployed at scale, and they all require silver. Unlike gold, which is primarily a monetary metal and store of value, silver straddles two worlds. It's both a monetary metal and an industrial commodity. This dual nature creates unique dynamics. Industrial demand provides a floor under prices that doesn't exist for purely monetary assets. Monetary demand provides upside potential beyond what pure industrial fundamentals would justify. Third, consider the supply constraints. Mining is a long cycle business. From discovery to production takes years, often a decade or more. The lack of significant new silver discoveries, combined with declining ore grades at existing mines, means supply growth is constrained even if prices rise substantially. When you combine constrained supply with growing industrial demand and increasing monetary demand, the fundamental case becomes clear. This doesn't guarantee prices go up in any particular time frame, but it does create the conditions where breakouts can become sustainable trends rather than false starts. Now we arrive at the heart of the matter, human psychology. Financial markets are ultimately games played by humans, driven by human emotions, subject to human biases. Understanding these patterns is more valuable than any technical indicator or fundamental metric. When an asset breaks out after a long consolidation, a predictable psychological sequence unfolds. First comes disbelief. Long-suffering holders don't trust the move. They've been disappointed too many times. They sell into the strength, happy to finally break even or take small profits. This selling provides the first test of the breakout. Then comes recognition. More investors notice the move. Media coverage increases. The narrative shifts from silver is dead to silver is breaking out. This brings the second wave of buyers, those who need social proof before taking action. Next comes enthusiasm. Early buyers see profits. They tell friends. Social media lights up with silver commentary. FOMO, fear of missing out, begins to take hold. This is typically where the dangerous acceleration happens. Finally comes euphoria or capitulation, depending on how the market resolves. Either prices accelerate to unsustainable levels, or they correct sharply, shaking out the weakest hands. Understanding where we are in this psychological cycle is crucial. Right now, we're likely somewhere between disbelief and recognition. The move is young, the majority hasn't caught on yet. This is both an opportunity and a danger. The opportunity is that we're not yet in the euphoric phase where terrible decisions get made. The danger is that many investors will wait for confirmation that the trend is real, by which point they'll be buying at significantly higher prices with significantly higher risk. It's worth considering what institutional investors, the sophisticated money that moves markets, likely see in silver right now. Institutions don't trade on hype. They trade on probability-weighted expected outcomes over multi-year timeframes. They think in terms of portfolio allocation, correlation structures, and risk-adjusted returns. From an institutional perspective, silver offers something increasingly rare: asymmetric return potential. The downside appears relatively limited. Even if silver corrects, industrial demand provides support. The metal has genuine utility. It won't go to zero. The upside, however, remains substantial if any of several catalysts fully materialize. Institutions also understand correlation. In a portfolio context, silver's low correlation to stocks and bonds makes it valuable for diversification. It tends to perform differently than financial assets during various economic scenarios. Furthermore, silver remains a small market in absolute terms. The entire above-ground investment-grade silver market is worth less than many individual companies. This means relatively small institutional flows can have disproportionate impacts on price. When institutional money begins rotating even a small percentage of assets towards silver, it creates sustained buying pressure that retail speculation alone cannot generate. This doesn't mean institutions are piling into silver en masse right now. It means the conditions exist for such flows to develop if current trends continue. And those flows would likely sustain a move far beyond what technical factors alone would justify. If you already own silver, you're facing a different set of decisions than someone considering a new position. First, resist the urge to sell simply because you're finally in profit. This is one of the most common and costly mistakes. If your original thesis for owning silver was sound, and if that thesis has strengthened rather than weakened, then being in profit isn't a reason to exit. However, being in profit does create options. Consider taking partial profits on a portion of your position, perhaps 10 to 20%, to lock in some gains and reduce your psychological attachment to the investment. This allows you to maintain exposure to further upside while removing the stress of potentially giving back profits. Use this opportunity to reassess position sizing. If silver has appreciated significantly, it may now represent a larger percentage of your portfolio than appropriate. Rebalancing isn't market timing, it's risk management. If silver was 5% of your portfolio and is now 10%, selling enough to bring it back to 5 or 6% isn't being bearish. It's maintaining discipline. Think in terms of tranches, not all or nothing decisions. If you plan to eventually reduce your silver position, establish price levels or time frames at which you'll sell specific portions. This removes emotion from the process and prevents paralysis. Most importantly, separate your investment from your ego. The fact that silver is rallying doesn't mean you were smart. The fact that you owned it during the breakout doesn't make you a genius. Markets reward and punish everyone eventually. Stay humble, stay rational. And remember, no asset rises forever. Every bull market, no matter how powerful, eventually ends. Your job isn't to capture every single point of upside. Your job is to participate in the move while maintaining the discipline to preserve capital when conditions change. If you don't currently own silver but are considering a position, you face the classic challenge. The asset has already moved. This creates psychological discomfort. You feel like you've missed it. You worry about buying the top. You wait for a pullback that might never come to the levels you hope for. Let me be direct. If your analysis suggests silver should be part of your portfolio, and if you're waiting for the perfect entry point, you're likely to either never buy or to buy at worse prices after chasing a further rally. The solution isn't to rush in emotionally. It's to implement a strategic entry plan. Consider dollar cost averaging over a period of weeks or months. Rather than deploying all intended capital at once, buy in increments. This achieves an average entry price and removes the pressure of timing a single perfect entry. Scale in on weakness, not strength. If you plan to build a position over 3 months, use price dips as your buying opportunities. This requires discipline. It means buying when it feels uncomfortable, when headlines are negative, when the price is falling. Alternatively, wait for a successful retest of the breakout level. Markets often return to test former resistance as new support. If silver pulls back to the level it broke through and holds, that's a higher probability entry than chasing the initial breakout. Size your position appropriately from the start. Silver is volatile. If you buy too much, you'll be unable to withstand normal volatility without panic selling. A properly sized position allows you to maintain conviction through inevitable drawdowns, and be honest with yourself about your time frame. If you're investing in silver for potential gains over 3 to 5 years, short-term price action shouldn't matter. If you're trading for gains over 3 to 5 months, you're not investing, you're speculating. Both are valid activities, but they require completely different approaches. Let's address the specific errors that destroy more wealth than any market move. Silver is already volatile. Amplifying that volatility with borrowed money is a recipe for catastrophic loss. Yes, leverage magnifies gains on winning trades, but it also guarantees eventual ruin because no one has a perfect track record. You'll face a margin call at precisely the wrong moment, forced to sell at a loss because you overextended. If you can't afford to buy physical silver or unleveraged positions, you can't afford to buy leveraged products. There are no exceptions to this rule for non-professional investors. Buying because you feel excited, selling because you feel scared, adding to positions because you're bored with the current holding. These emotional impulses will destroy any edge your analysis provided. Develop a written plan before deploying capital. Stick to it. Review it periodically, but not daily. Make changes deliberately, not reactively. You are not your investment portfolio. Silver rallying doesn't make you smarter. Silver falling doesn't make you stupid. When your ego becomes attached to a position, you lose the ability to make rational decisions. Successful investing requires the ability to admit error and change course. That becomes impossible when being wrong would hurt your self-image. Silver shouldn't be your entire portfolio. It shouldn't be 50% of your portfolio. Even if you're extremely bullish, concentration risk is real. Diversification isn't about maximizing returns. It's about surviving long enough to compound wealth over time. A reasonable allocation might be anywhere from 5 to 15% of investable assets, depending on your situation and conviction. Beyond that, you're speculating on a single asset rather than building a resilient portfolio. Most investors spend all their time analyzing entry points and none planning exit strategies. This means they ride winners back down to losses, unable to make selling decisions because they never established criteria for doing so. Before you buy, know the conditions under which you'll sell. Not specific price targets necessarily, but scenarios. If fundamentals deteriorate in specific ways, you sell. If technical support breaks decisively, you sell. If the position grows beyond your target allocation, you rebalance. Social media, financial television, newsletter hype, these sources aren't designed to help you build wealth. They're designed to generate engagement, sell subscriptions, and create advertising revenue. The most useful information is often boring. Fundamental analysis, historical context, probability assessment, these don't generate clicks, but they generate returns. Be selective about whose analysis you trust. Look for track records, not charisma. Seek those who explain their reasoning, not those who simply state conclusions. Every trade has costs, brokerage fees, bid-ask spreads, taxes on gains. Frequent trading compounds these costs, creating a significant drag on returns. This doesn't mean never sell. It means being thoughtful about it. A small tax bill from long-term capital gains on a profitable investment is a good problem to have. Frequent trading that generates short-term capital gains, taxed at ordinary income rates while racking up transaction costs, is self-sabotage. Silver doesn't move in isolation. Its behavior provides signals about broader market dynamics that extend far beyond the metal itself. When silver breaks out alongside gold, it often signals increasing concern about monetary stability. Investors are rotating toward hard assets, suggesting reduced confidence in financial assets or currencies. When silver leads gold, outperforming on a percentage basis, it often indicates that the move has speculative elements. Silver's higher volatility attracts traders and momentum investors in ways that gold doesn't. Currently, we're seeing both dynamics. Gold has been strong, establishing new all-time highs. Silver is playing catch-up, but with conviction. This pattern suggests both monetary concern and increasing speculative interest, a combination that can fuel sustained moves, but also creates eventual reversal risk. Watch the gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has ranged from around 15:1 to 100:1, with an average somewhere in the 50-60 range. When the ratio is extremely high, silver is historically cheap relative to gold. When extremely low, silver is expensive. If this ratio begins compressing significantly, moving from 80.1 toward 50:1, for example, it would confirm that silver's move has fundamental strength beyond mere speculation. Also, watch industrial commodity prices generally. If copper, aluminum, and other industrial metals are strong, it confirms the industrial demand narrative for silver. If they're weak, while silver rallies, the move is more purely monetary, which changes the risk profile. Let me inject some necessary realism into this discussion. Silver might not sustain this breakout. It could rally further, then reverse sharply. It could consolidate for months before the next move. It could surprise everyone by accelerating beyond what seems reasonable. Nobody knows which scenario will unfold. Anyone who claims certainty is either lying or delusional. What we can say is that conditions favor continued strength over the intermediate term. Fundamentals support higher prices. Technical patterns suggest a shift in trend. Sentiment hasn't reached extremes that typically mark tops, but markets don't care about our analysis. They don't respect our logic. They do what they do, driven by millions of participants making billions of decisions for thousands of different reasons. Your edge isn't in predicting the future with certainty. Your edge is in positioning appropriately for multiple scenarios, managing risk, and maintaining the emotional discipline to stick with sound strategy when it feels uncomfortable. Some of you watching this will make money on silver. Some will lose money. The difference won't primarily be luck. It will be discipline, position sizing, and emotional control. Step back for a moment and consider silver's long-term history. For thousands of years, silver served as money. Not just a commodity, not just a metal, but actual money that people used for daily transactions. This wasn't arbitrary. Silver's properties made it suitable for monetary use, divisible, durable, portable, and scarce enough to retain value. That monetary history ended relatively recently. The United States removed silver from circulating coinage only in 1965. We've had less than 60 years of silver as purely an industrial commodity and investment asset, rather than money. In the grand sweep of human economic history, this is an eye blink. When we view silver through this lens, current prices seem remarkably modest. Adjusted for inflation, silver remains far below its 1980 peak, far below its 2011 peak. Even after the recent breakout, silver is not expensive by historical standards. This doesn't guarantee future gains. The past doesn't repeat exactly, but it provides perspective that can prevent panic during volatility and prevent euphoria during rallies. Silver has survived every empire, every currency, every financial system humans have created. It will survive this one too. The question is whether it will thrive in your portfolio or become a source of regret due to poor decision-making. The strategic framework. Building your approach. Let me provide you with a framework for thinking about silver strategically, regardless of your current position. Start with purpose. Why are you considering silver? Is it portfolio diversification, inflation protection, speculation on a trend, long-term wealth preservation? Your purpose determines everything else. If diversification and preservation are your goals, physical silver or highly liquid ETFs held for years make sense. If speculation on trends is your goal, you need different vehicles and different time frames. Next, establish allocation. How much of your portfolio should this represent? Be honest about your risk tolerance and financial situation. Someone with stable income and minimal debt can take more risk than someone approaching retirement with fixed income. Then, choose vehicles. Physical silver offers no counterparty risk but has storage and liquidity considerations. ETFs offer liquidity and ease but introduce counterparty risk. Mining stocks offer leverage to silver prices, but add company-specific risk. Each has appropriate uses. Develop entry and exit criteria. Not specific prices necessarily, but conditions. I'll buy on pullbacks of 5% or more. I'll sell if industrial demand contracts significantly. I'll rebalance if the position exceeds X% of my portfolio. Finally, commit to discipline. Write down your plan. Review it when tempted to deviate. Understand that the plan protects you from yourself, from emotional decisions made in moments of fear or greed. This framework won't guarantee profits, but it will prevent the most common causes of catastrophic loss. It's worth considering the bear case, even if you're bullish. What if silver's breakout fails? What if this is just another false start, like several we've seen over the past decade? Perhaps industrial demand disappoints as economic growth slows. Perhaps substitution accelerates as high prices incentivize alternatives. Perhaps monetary policy tightens more than expected, strengthening currencies and reducing hard asset demand. Any of these scenarios is possible. None would be unprecedented. This is why position sizing matters so much. If you're right about silver and it advances significantly, a 10% portfolio allocation will still generate meaningful returns. If you're wrong and it declines significantly, a 10% allocation won't destroy your financial life. The goal isn't to maximize returns on any single position. The goal is to build a portfolio that performs adequately across a wide range of scenarios and allows you to sleep at night regardless of market conditions. Conviction without humility leads to disaster. Maintain both. Silver has broken free from years of consolidation. This is a fact, not an opinion. What happens next is uncertain. This is also a fact. Your task isn't to predict the future with impossible precision. Your task is to assess probabilities, position appropriately, and maintain the discipline to execute your strategy regardless of how you feel in the moment. Most people watching this video will do nothing. They'll watch silver move, feel regret about missing it, then buy at higher prices when emotion overwhelms reason, or they'll buy impulsively right now, without a plan, without appropriate position sizing, and panic sell at the first significant pullback. A small minority will approach this opportunity strategically. They'll assess their situation honestly. They'll develop a rational plan. They'll implement it with discipline. They'll manage their emotions. They'll treat investing as a marathon, not a sprint. That minority will build wealth over time, not because they're smarter or luckier, but because they're more disciplined. The opportunity in front of you isn't really about silver. It's about your relationship with money, risk, and decision-making. Silver is simply the current arena where that relationship gets tested. Markets will always create opportunities. The question is whether you'll be positioned to capitalize on them when they arrive, or whether you'll be recovering from the last mistake you made, chasing the previous opportunity. Build systems, not wishes. Plan for multiple scenarios, not just the one you hope for. Size positions for survival first, profit second. Control what you can control, your behavior, your risk, your discipline. The silver market has changed. The question is whether you'll change with it in a way that serves your long-term interests. The breakout has happened. The opportunity exists. What you do with it will determine whether you look back on this moment with satisfaction or regret. Choose wisely, execute deliberately. And remember that in investing, as in life, patience and discipline compound into results that urgency and emotion can never achieve. The market doesn't care about your financial goals. It doesn't care about your timeline. It simply is. Your job is to adapt to reality rather than demanding reality adapt to you. Silver has broken free. Now it's your turn to break free from the emotional patterns and behavioral mistakes that have held back your financial progress. The path forward is clear. Whether you walk it is up to you.